Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 4th of August. Today, the US employment report for July will take center stage. The forecast is for non-farm payrolls to have risen by 183k, less than the 222k in June, but still a number consistent with further tightening in the labor market. The unemployment rate is expected to have ticked back down to 4.3%, while average hourly earnings are forecast to have accelerated in monthly terms. Overall, this looks like another strong employment report, which could revive some expectations for another Fed rate hike this year. That probability is currently 45% according to the Fed Fund futures. Something like that could help the dollar recover some of its latest losses. However, we think that the main determinants of whether the Fed will indeed proceed with another hike this year are inflation data. The latest prints showed that the headline inflation slowed for the fourth consecutive month, while the core rate remained unchanged after falling for 4 months in a row as well. In our view, a strong rebound in inflation is needed before rate hike expectations rise materially and help the dollar reverse its latest downtrend. Dollar CAD traded in a consolidative manner yesterday, staying between the support of 125.30 and the resistance of 126.15. Having in mind that the rate is still trading below the short-term downtrend line taken from the peak of the 9th of June, we consider the short-term downtrend to still be intact. However, the rate failed twice to break below 124.15 recently, while there are expectations of a solid US employment data later in the day and a neutral Canadian jobs report. All this makes us believe that there is a decent probability for the pair to trade higher today and perhaps break above the aforementioned short-term downtrend line. A break above that line and 126.15 may initially aim for our next resistance of 127. Switching to the daily chart, although a break above the short-term downtrend line may signal a short-term trend reversal, as long as the rate is trading below the psychological zone of 130, we consider the broader outlook to be cautiously negative. We would treat a possible short-term reversal as a corrective rebound. Now moving to the UK, the Bank of England kept its policy unchanged yesterday via a 6-2 vote, as was anticipated. Even though the bank reiterated that policy may need to be tightened to a somewhat greater extent over the next 3 years than what is currently implied by market pricing, it signaled little urgency for a hike in the next few months. In addition, it revised lower its inflation and economic growth forecasts. The bank's neutral tone, combined with the downgrade of its forecasts, likely disappointed investors looking for hawkish signals that a rate hike is imminent. The fact that the vote was 6-2 may have also been seen as a negative surprise, as some participants may have expected Haldane to join the hawks and vote for a hike too. The result was weaker sterling. Now, as for the pound's forthcoming direction, in the absence of any Brexit headlines to guide the currency over the next few days, movements in pound crosses are likely to depend primarily on the pound's counterparts. Specifically, GBP may continue to gain against the weak dollar, but perhaps remain on the back foot versus the almighty euro. Euro sterling surged yesterday on the Bank of England decision. The rate emerged above the psychological barrier of 0.90 to challenge our next hurdle of 0.9050. Given that yesterday's rally confirmed the forthcoming higher high, we believe that the outlook remains positive. We would expect a decisive break above 0.9050 to open the way for our next resistance of 0.9125. Nevertheless, bearing in mind that the Bank of England surge appears overextended, we are mindful of a corrective retreat due to some profit taking. Such a retreat may challenge the 0.90 territory as support this time before the bulls decide to shoot again. Now, as for the rest of today's highlights, besides the US jobs figures, we get employment data for July from Canada as well. The forecast is for the unemployment rate to have remained unchanged, while the net change in employment is expected to have declined, but to remain in positive territory. In such a case, the reaction in the Canadian dollar may be relatively limited. That said, we should stress that we view the risks surrounding cuts' forthcoming direction as being asymmetrical. Market pricing currently suggests that another Bank of Canada rate hike by year-end is fully priced in. Therefore, if economic data and developments are encouraging over the next months, they would only confirm the current sentiment and may thus have little positive impact on the Canadian dollar. On the other hand, in case economic indicators deteriorate, expectations for a hike could quickly decline, leading to a significant downside correction in the loonie. Now, as for the speakers, Bank of England Chief Economist and Monetary Policy Committee member Andy Haldane will deliver some remarks. For more information, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.